All right, looks like we're live. Welcome everybody to live valuation. I'm Midas Moriarty. Today we're going to be taking a look at ticker SBUX, Starbucks. Just give me one moment to double check the stream and make sure everything is running smoothly before we get started. Okay, everything looks good. So, before we get into today's valuation, I kind of want to go over a new piece of my portfolio and watch list spreadsheet that I've put together, which is this markets page. It's a little bit of a work in progress. I'm still fixing some of the formulas and adding some more to it, but at least the main sections of it are sort of done, which is this to replace the indicator spreadsheet that I used a lot of in the earlier part of last year to track my own portfolio returns against various indexes, while also trying to give a bunch of week by week market and economic related data in the more prepared video content that I was doing at the start of last year, before I started streaming in April. And then pretty soon after that, I shifted to all streaming content. But now I've re-put this together, fixed a few of the problems I had with the previous spreadsheet, and hopefully I plan to kind of go over this a little bit at the start of every stream, or at least once a week. So basically, to explain this, we have returns over various periods for a variety of different asset classes and markets. And we have my own portfolio at the top. We have the world stock market index is the entire world stock market. The Wilshire 5000 is a representative of the entire U.S. stock market. And then the entire world stock market ex-US. So these two main indexes are essentially two halves of the world total index. And then in the Wilshire 5000, I have that essentially sectioned off into two main sections, the S&P 500 and the Russell 2000, which isn't a perfect composite of all of that, but it basically gets the job done. And then these two main sections are also split off into the main industry indexes, which I'm using Vanguard indexes for my proxies for these industries. And then in the world ex-US, I have that sectioned off as well into two main indices, the developed and emerging. Both of those are also Vanguard indices. So between all of these indexes right here, I can track the entire world stock market in different subgroups and track that against my own portfolio returns here. And then below that, we also have bond returns of different categories. There. We have the U.S. federal treasury debt, as well as non-U.S. sovereign debt of developed markets as well as emerging markets. And then we have corporate U.S. debt of an investment grade, and then corporate high yield U.S. debt, and then corporate emerging market investment grade, and corporate emerging market high yield. Both of these indices are debt denominated in USD or EUR, while as the sovereign debt categories are denominated in non-USD terms. And then I'm working on a commodities section as well, but like I said, it's a little bit of a work in progress for some of these formulas still need to be worked on. The main timing categories we have here, we have the returns for today as well as this week, and then 1 month, 1 year, and 3 month rolling periods that adjust every single day, as well as the returns as of this year. And then we also have compounded periods, pre-pandemic, meaning since 12/31/2019. So basically the end of 2019, I'm considering a stopping point for seeing where things have moved since the beginning of COVID. And then since starting, that refers back to essentially when I started investing about 3.5 years ago. So looking at returns all over that relative period as well. And then a 5-year, 10-year, and 14-year compounding period. Now I chose 14 years mostly because many of these indices begin in that year, most of these ones in particular. It would perhaps have been better to have chosen a 15-year period over a 14-year, but that is just the way it is. And it is also worth noting that for a few of these, I don't have actually a full 14 years. For example, the World Total Index, I only have 13 years, which we signify right here. And then the Wilshire 5000, I only have 11 years, which we signify here. As well as I only have 13 years as well for this category down here. and then the World ex-US, I was only able to get up to the 10-year period for this one. So there are some limitations on the data, and it's also worth noting that I did take the time to do my best estimate of dividend reinvestment for all of these categories. So this should represent total returns compounded. It's going to be an estimate. All of these could be give or take 1 percentage point or so of a standard error. And then the green and red categories are actually meant to help reflect that, so that if something is highlighted in green, that means it is more than 1% ahead of wherever the S&P 500 is in that category. All of these are relative to the S&P 500. And then the red means it's more than 1% below that in any particular category. So we consider above 1 or below 1% in either in any of these particular subcategories to be essentially an insignificant difference. So either way, that's the new spreadsheet I've been working on this week. Like I said, I will be using it to kind of regularly go over where things are in the markets as far as each week's market returns go. And so kind of like talking about that, we can look at this week and we can see that, yeah, the S&P 500 is down a little over 0.5% this week, while the Russell 2000 is actually down about 2%. Putting those two together, you can see that the Wilshire 5000 is down about 1%, while the world index is actually about flat on total. Now, winning categories as far as industry goes this week seems to be energy as well as financials, and the developed and emerging markets seem to also have done particularly well, the entire world ex-US. And then in other categories, like I said, I still need to fix some of these formulas, so I won't really go over these too much today, but they're down there as well. Against that, however, my portfolio has done 1.85% this week against the S&P's 500 negative 0.68. That's pretty good. On the 1 month, this year, 3 month and 1 year period, we are beating the S&P 500. Pre-pandemic, we are not. And since starting, we're roughly even with them. So that's where things currently stand today. So having covered that, we'll now actually get into SBUX, the main valuation that we're going to be covering for today. I have already done all of the prep work for them, getting their book listed values of debt, $23.7 billion approximately, with 11 years average maturity at the 2.95% weighted average interest rate. That includes the effective issuance and hedging activities for them in the interest rate. For their geographies, they have about 70% of their sales in the US, with 12% in China and 17% the rest of the world. 60% of their assets in the US, 21% in China and 20% in the rest of the world, getting them an overall geographic country risk premium after adjusting for the update ratio of about 5.24. We have an unlevered weighted beta for them of 1.03, with sales to capital ratio for industrial expectations of 1.32, and then adjusted net margin expectations of 13.2. So pretty high sales to capital and net margin expectations, but that is counterbalanced with a relatively high unlevered weighted beta. Sorry about that. My drink's like trying to bubble over here onto my desk. Try to mute whenever I do weird slurpy noises. But yeah, so that is not a very high beta on its own, but considering it hasn't been adjusted for the leverage, that does mean that that could end up being a relatively high beta depending on the overall leverage of the company, which, like I said, is $23.7 billion against a $120 billion market cap. So we'll see where that actually ends up in the end. So I already did 1 year's worth of the financial statement data, as I normally do. I'll play the fourth quarter earnings call while we get into the rest of the numbers.
My name is Alex, and I will be your conference operator today. I would like to welcome everyone to SBUX fourth quarter and fiscal year-end 2021 conference call. All lines have been placed on mute to prevent any background noise. After the speaker's remarks, there will be a question and answer session. If you'd like to ask a question, simply press star, then the number 1 on your telephone keypad. If you'd like to withdraw your question, press the pound key. I will now turn the call over to Greg Smith, Vice President of Investor Relations. Mr. Smith, you may now begin your conference.
Good afternoon, everyone. Thank you for joining us today to discuss SBUX fourth quarter and fiscal year-end 2021 results. Today's discussion will be led by Kevin Johnson, President and CEO, and Rachel Ruggieri, CFO. And for Q&A, we will be joined by John Culver, Group President, North America and Chief Operating Officer, Michael Conway, Group President, International and Channel Development, and Leo Soy, Chief Executive Officer, Starbucks China. This conference call will include forward-looking statements which are subject to various risks and uncertainties that could cause our actual results to differ materially from these statements. Any such statements should be considered in conjunction with cautionary statements in our earnings release and risk factor discussions in our filings with the SEC, including our last annual report on Form 10-K and quarterly report on Form 10-Q. Starbucks assumes no obligation to update these forward-looking statements or information. GAAP results in fiscal 2021 include several items related to strategic actions, including restructuring and impairment charges, transaction and integration costs, and other items. These items are excluded from our non-GAAP results. For non-GAAP financial measures mentioned in today's call, please refer to the earnings release in our website at investor.starbucks.com to find a reconciliation of these non-GAAP measures to their corresponding GAAP measures. This conference call is being webcast, and an archive of the webcast will be available on our website through Friday, November 26, 2021. For your calendar planning purposes, please note that our first quarter and fiscal year 2022 earnings conference call has been tentatively scheduled for Tuesday, February 1st, 2022. Before we begin, there are 4 reminders I'd like to make with respect to the numbers that will be discussed on today's call. First, as noted in our earnings release, we have realigned our fully licensed Latin America and Caribbean markets to our international segment. As a result, we renamed the Americas segment to North America. All discussions and comparisons today are reflective of the resegmentation. Second, a reminder that Starbucks fiscal year 2021 is a 53-week year instead of the usual 52 weeks. Fiscal year 2021 results on today's call are on a 14-week basis for the quarter and 53-week basis for the year, except year-on-year comparative metrics, including revenue growth, comp growth, EPS growth, and margin expansion, which are based on a 13-week or 52-week basis to exclude the impact of an extra fiscal week. Third, all references on today's call are on a non-GAAP basis, unless otherwise noted. And lastly, effective in the first quarter of fiscal 2022, certain international integration-related expenses previously excluded from our non-GAAP results will be included, as they are expected to be representative of ongoing operations. Please refer to the reconciliation of these measures and a schedule showing adjusted fiscal 2021 EPS to bridge year-on-year impacts of this recast, as well as reconciliations of 53-week to 52-week metrics at the supplemental financial data section of our website at investor.starbucks.com. I will now turn the call over to Kevin.
Well, thank you, Greg, and welcome everyone to today's call. I'm very pleased to comment on the record Q4 and FY21 results Starbucks reported today. I'm particularly pleased that we were able to deliver these results in Starbucks' 50th anniversary year and in the face of increased costs and unprecedented operating challenges resulting from the global pandemic. Today's results reflect very strong operating and financial performance across the board, with Q4 revenue growing 22% and full-year non-GAAP EPS up 168% over the prior year. This was a record Q4 that punctuates a very strong FY21 performance with record highs in revenue, non-GAAP operating income, and non-GAAP EPS. Our performance accelerated throughout FY21, fueling revenue growth of 21%, non-GAAP operating income grew 139%, and translated to a non-GAAP earnings of $3.24 per share, near the high end of our guidance for the year. Perhaps more persuasively than ever, the strength and resilience of the Starbucks brand and the power and opportunity afforded by the authentic connection and the deep trust and loyalty we have built with customers around the world is resonating. Today's results demonstrate that despite the pandemic, Starbucks' long-term double-digit growth at scale model remains solidly intact. Today's results also underscore the passion and dedication of our over 400,000 Starbucks Green Apron partners, who serve nearly 100 million customer occasions around the world every week. And I'm humbled by our partners' commitment to each other and to our customers as we continue to navigate through the pandemic. Their resilience and service honors the company and our history, and I could not be more appreciative of their efforts. Finally, today's results demonstrate the success of the investments we have made and will continue to make ahead of the growth curve in our people, digital, beverage and food innovation, and store experiences. These investments are driving and strengthening our global business and setting us up for even greater success in the future. Starbucks' long-standing view is that our partners guide this company, and we applaud other like-minded companies who are following our lead. Starbucks has been at the forefront of investing in our people since we opened our first store in the Pike Place Market in Seattle in 1971. We offered paid company health care 25 years before the Affordable Care Act, equity ownership in the form of bean stock to eligible part-time partners, free college tuition through the Starbucks College Achievement Plan with Arizona State University, and mental health support through our partnership with Lyra. Investing in our people is the cornerstone of our storied 50-year history and tradition. And these investments continue to deliver real, measurable value to our partners, our customers, and our shareholders. I'll be providing granularity around the incremental partner investments we made beginning last year and the additional partner investments we will be making in fiscal 22 in a moment. On today's call, I will highlight Q4 performance in our key markets and provide detail around some of our actions and investments since the pandemic first surfaced in Q2 of 2020 that are contributing to our performance today and setting us up for accelerated growth in the future. I'll also open a window on our exciting holiday plans and several initiatives that will launch over the near term. Then I'll turn the call over to Rachel to provide a deep dive into our Q4 and fiscal year performance and share our guidance for fiscal 22. We'll then move on to Q&A. Over the last 18 months, Starbucks, like most global retail operators, has been confronted with a seemingly never-ending wave of consumer and business headwinds. Many businesses in our space have not survived. From day one of the pandemic, Starbucks leaders around the world were determined to use the company's size and scale to navigate whatever challenges lie ahead. With steadfast commitment to our people, our mission and values, a set of principles guided us through the pandemic. Every decision was rooted in our core purpose and reason for being. These decisions have made the Starbucks of today stronger and better positioned to profitably grow, extend our coffee leadership around the world, and create more value for our shareholders more than ever before in our history. Last year, we made significant pandemic-driven strategic investments, including providing our partners with financial support and economic certainty, avoiding layoffs while most of our stores were temporarily closed, and accelerating our U.S. store portfolio transformation by opportunistically repositioning 500 stores to better locations with more favorable economics. To this last point, we expanded our portfolio of drive-thrus, introduced new store formats to meet our customers where they are, and turbocharged growth in our digital customer relationships in the U.S. and China. As a result of these successful investments, we are entering fiscal 22 with strong momentum around the world. In the U.S., our largest global market, our key growth driver is comparable sales. We grew a strong 2-year comp to 11% in Q4, despite variants across the country that created a dynamic set of city-by-city COVID restrictions, which we had to navigate. We made significant progress addressing supply chain issues and experienced an overall improvement in inventory availability as we moved through the quarter by increasing production at existing suppliers, onboarding new suppliers, and strategically prioritizing key holiday and Q1 merchandise. While we made significant progress at addressing supply chain challenges as fiscal 2021 progressed, we remain cautious and vigilant as we enter fiscal 22, given the dynamic nature of the situation. The recovery in Q4 surged forward as evidenced by the sequential acceleration of 2-year comp growth. We exited Q4 with even stronger 14% two-year comp growth in September, and closed to a record average ticket, driven by the strength of our fall beverage lineup, a shift in customer behavior toward more premium beverages, and strong food attach. We have great confidence for the year ahead, given the comp momentum throughout the quarter, combined with holiday plans certain to excite and delight our customers, and increasing consumer demand around the world today for everything Starbucks. Yesterday, we made an important announcement to raise wages across the U.S. in fiscal 22 to ensure we continue to attract and retain talented partners as consumer mobility continues to increase. We believe this investment, combined with our industry-leading benefits program, will enable us to remain an employer of choice. This builds on the historic partner investments and meaningful wage increases we made in fiscal year 21, and prioritizes significant additional investment to address inflation and wage compression that our tenured partners have experienced, while also increasing our wage floor. In December of 2020, I announced our intention to provide a starting wage of at least $15 an hour for our store partners across the country. And by the summer of 22, we will have delivered on that plan. Effective in January, partners with 2 or more years of service will get up to a 5% raise, and partners with 5 or more years will get up to a 10% raise, in keeping with our long-standing history of investing in our partners. And next summer, hourly partners in the U.S. will make an average of nearly $17 an hour, with barista rates ranging from $15 to $23 an hour across the country. In total, the FY21 and FY22 investments represent approximately $1 billion in incremental annual wages and benefits. We continue to build a great and enduring company by investing ahead of the growth curve, not just in wages, but in training and technology and the overall Starbucks experience for both our partners and our customers. And as we have seen in the past, we expect investment in the partner experience will be accretive to profits over time. We believe the U.S. market is at a unique inflection point. Stakeholders and companies whose leaders correctly identify emerging trends, thoughtfully shape strategic action, and invest in the future will be big winners over the long term. In the quarters ahead, Starbucks will continue to target investment in high-returning assets that we believe will accelerate our double-digit growth at scale model, driving long-term, sustainable, and profitable growth. We continue to build and leverage our technology-first, mobile and digital capabilities, and accelerate growth in active Starbucks Rewards membership. We grew our 90-day active Starbucks Rewards members, representing our most loyal and engaged customers, by approximately 30% in fiscal year 21 to 24.8 million members. Noteworthy is that in Q4, 51% of U.S. tender for company-operated stores was generated by this loyal customer base. We continue to nurture and deepen our direct, personalized digital relationship with our members with enhancements to the program, like Stars for Everyone to expand reach, and through payment partnerships with PayPal and Bakkt, where a customer can now reload their Starbucks card with a range of cryptocurrencies, including Bitcoin, Ethereum, and others, by converting digital currencies to physical currency and reloading their Starbucks card. Through blockchain or other innovative technologies, we are exploring how to tokenize stars, create the ability for other merchants to connect their rewards program to Starbucks Rewards. This will enable customers to exchange value across brands, engage in more personalized experiences, enhance digital services, and exchange other loyalty points for stars at Starbucks. An example of this innovation is evident in the recent launch of our Canadian loyalty program with Air Canada. Over the next year, you will see the first instance of this loyalty points exchange with other consumer brands. This approach will also serve as a foundation for a more aspirational concept for new, modern payment rails that align payment expenses with the value received by customers and merchants. We intend to be at the forefront of this disruptive innovation, which will unfold over the next few years. Finally, a rich pipeline of innovation will elevate the Starbucks experience in our stores and drive in-store productivity gains. Examples include our Mastrena 2 espresso machines that more efficiently pulls triple shots of high-quality espresso, our Deep Brew artificial intelligence platform that has automated daily inventory management, and store staffing and training improvements designed to reduce complexity in our stores. Simplifying this workflow helps reduce the strain on our partners, resulting from the ever-increased demand in our stores, and enables our partners to connect and engage with their customers, which is at the heart of the Starbucks experience. Starbucks is entering fiscal year 22 with strong customer demand and solid momentum in our U.S. business, an expanding and accelerating in-store channels and digital flywheel, and Green Apron partners eager to deliver an elevated Starbucks experience to their customers. Having navigated through so many challenges over the past year, we are excited and optimistic about the year that has just begun, while remaining humble and mindful of unknown challenges. On to China. Starbucks China extended our market leadership position in Q4, despite pandemic-driven disruptions, propelled by an accelerated pace of store development and significant growth in digital customer relationships, all while achieving record customer engagement scores in the quarter and in the year. Starbucks has built one of the most respected consumer brands in China, with 1 in 2 consumers preferring Starbucks to any other brands in away-from-home coffee. Our growth strategy in the market continues to differentiate us and position us well for the long game. We continue to invest meaningfully in all aspects of our China business, including accelerated investment in our partners, the creation of award-winning experiential store designs, unprecedented benefits like healthcare for partners and their parents, rent assistance, and programs that offer career paths for young people from rural and remote provinces. Together, these investments further elevate the Starbucks brand and partner experience. They instill pride in our China partners and deepen our customer engagement and connection. Starbucks continues to be in a strong market expansion cycle, and as such, much of our growth in China comes as we aggressively expand our store footprint and introduce more customers to the Starbucks experience. We expanded the store footprint with 225 net new stores in Q4, and we are going deeper and broader. Deeper into existing cities and broader by opening in new cities. For the full fiscal year, we opened a record 654 net new stores and ended the year with 5,360 stores in 208 cities throughout China. As we noted on our Q3 earnings call, our recovery in China will not be linear. In Q4, we experienced COVID-related restrictions that constrained customer mobility in 18 provincial-level regions. At its peak in mid-August, approximately 80% of our stores in China were impacted by the pandemic, with some stores fully closed or operating at different levels of elevated public health protocols, such as mobile ordering only, limited seating, or health stations. Our recovery momentum was below expectation and pushed our 2-year comps to a -10% in Q4. Cities with local COVID cases were impacted the most, with stores relying on transportation and tourism also materially impacted during the quarter. Notably, though, much like the U.S., China 2-year comp also accelerated in the month of September, as we remain optimistic for the recovery. Despite these strong headwinds, China grew revenue 11% year on year. While our overall reported comp growth was -7% for Q4, if we exclude the lap of a VAT subsidy we received in fiscal year 20, along with the stores and cities that experienced local COVID cases or were in transportation and tourism zones, our core fleet of stores comped positive. Starbucks business and operating margins remain strong, and our commitment to China and our confidence in our long-term growth strategy in China is unwavering. In addition to expanding our portfolio of stores in China, we also expanded our digital footprint of 90-day Starbucks Rewards active members, reaching an all-time high of $17.9 million in Q4. This represents a sequential increase of 5% over Q3 and an increase of 33% over prior year. Frequency of purchases by our Gold members remained at pre-pandemic levels despite the mobility limitations in the quarter, demonstrating the effectiveness of our efforts in up-leveling member engagement. One example was our Star Dash Gift with Purchase campaign that successfully lifted member frequency and spend and evolved into a highly anticipated activity for members to earn limited availability to Starbucks' 50th anniversary merchandise. With operations heavily impacted by COVID-related safety restrictions in the quarter, we are laser focused on what we can control in China, while continuing to elevate our partner and customer experiences to further elevate the Starbucks brand and build on the loyalty that will continue to drive our long-term growth. Including the US and China, Starbucks' presence in 84 markets around the world provides us with a unique perspective on the global recovery from this pandemic. There is no doubt that we are seeing continued recovery in our markets. Latin America grew system sales by 113% in Q4, driven by a strong recovery in Mexico. EMEA posted system sales growth of 52% in the quarter, and Japan navigated through a challenging quarter, turning the corner towards renewed growth. We see positive signs in many other markets, as well as reinforcing our belief that pandemic-related headwinds are temporary. In addition, our strategic channel partnerships with the North American Coffee Partnership with PepsiCo and our Global Coffee Alliance with Nestle are on plan and have propelled Starbucks to #1 share positions in the US and throughout many other markets around the world, further underscoring the strength and resilience of the Starbucks brand and illuminating the decades-long runway of growth ahead. As we enter fiscal year 22, we are fully prepared for a record-breaking holiday, with strong growth planned around the world and a holiday campaign designed to build genuine human connection as only Starbucks can, at a time when human connection is more important than ever. In addition to new and iconic seasonal products, we are integrating brand building and transaction-driving marketing programs to demonstrate our values and touch our customers' hearts. We are prepared with inventory this holiday, and we are also anticipating that nearly $3 billion will be loaded on Starbucks cards this season by leveraging our digital and out-of-store distribution channels and creating a promotional presence in drive-through lanes.
All right, so finished with the first 5 years. We'll go ahead and do a little bit of an analysis over that. Watch on INMD and Halazim. I'll add them to the list, my man. I'll check them out. No guarantees that I'll do a stream on them or anything, but I mean, I'll see if there's something appealing or not. So taking a look at these first 5 years, starting with the sales to capital ratio, you can see that in the most recent 3 years, they had an average of 5.34, but that's mostly due to this kind of irregular year of 2019 as well as 2018, where the sales to capital ratio was extraordinarily high. That has to do with a pretty large seismic shift in their overall capital base in between those years, which as we move further up into the balance sheet, you can kind of see that their liabilities jumped rather dramatically between 2017 and 2018 as they took on a huge amount of debt and acquisitions. So they really shifted their capital structure. Prior to that, they didn't have actually very much debt at all, and so by basically doubling their overall debt piles, I do believe they actually also acquired relatively good interest rates. Don't pay any attention to that. We're way too early in any of this, but going back down to their book values of debt, they got 11-year weighted average maturity at 2.95% interest rate. So that's a pretty decent overall capital blend to have for their overall expensing. Looking at their current assets and versus current liabilities, you can see their overall current liabilities have doubled basically over the period, while their current assets have also almost doubled. So on net, that's still pretty good. They've jumped up rather large in their long-term debt, but their current assets have jumped up pretty consistently with that. you'll see the huge jump in the cash relative to that, while the marketable securities have stayed pretty even, as well as it's worth noting that their accounts receivables and their inventories haven't exploded with that. So that's a pretty good sign. So it's a good use of capital. Taking a look at the cash flows, see over the 5-year period, the sum of their free cash flow to equity was 3.4 or $34.3 billion, and the overall cash flow paid to the shareholders during the period was $28.8 billion. So they aren't overpaying their shareholders. That's a pretty good sign, which balances off with the factor that I didn't point out, which is that they have negative shareholders equity and negative retained earnings, which did happen within that period as a result of taking on that large amount of debt. So you could say that, I've mentioned before in various other streams, that I'm usually a little cautious when I see negative shareholders equity or negative retained earnings. It's not a deal breaker, but it is something that I'm concerned with if they're putting a huge amount of share buybacks into work. I like to see share buybacks happening while retained earnings are still growing. But since they're not overpaying their shareholders, you could argue that this is essentially paying it forward in a sense and preparing for future jumps in valuation. Then moving back up to their corrected net margins, they do have a pretty consistently strong net margin, which balances off with a relatively strong sales to capital ratio. So the qualitative factors that we were looking at in regards to the balance between those two seems to be pretty strong. We'll see where the leverage levels end up making their beta come out at the end of the day. And then on top of that, we can look at the overall sales growth. They have pretty even sales levels that had a pretty strong decline in 2020, and then that bounced back pretty strongly in 2021. Between the 2 years overall, including the year prior to that, the overall CAGR on the 3-year period is about 5%. So you can see that really it just kind of kept chugging in a pretty consistent basis. We'll see what the 5-year CAGR looks like rolling over a 10-year period though, and we'll get back to the numbers. Sorry man, I don't have Telegram, unfortunately. If you go to my YouTube page, which I hope you subscribe and like the video, you can find a link to my Linktree, which has a variety of other platforms that I'm on. I'm not on Telegram, but you can contact me either directly through Facebook, or you can contact me on on Facebook, YouTube, BitChute, Minds. There's a variety of other places you can contact me on through there. Discord, that's an option too. Yeah. Anyway, I'll get back to the earnings call,
where we have seen significant channel shift during the pandemic. We are ready for this holiday. In closing, Starbucks' strong performance through the recovery is a direct result of the hard work and dedication of our partners, as well as the investments we made both before and during the pandemic. We remain confident in our future and steadfast in our commitment to deliver long-term value to all stakeholders. This confidence supports the plan we announced today to return $20 billion to shareholders over the next 3 years through dividends and share repurchases. I'm particularly pleased that hundreds of thousands of Starbucks partners who are also Starbucks shareholders through our Beanstock program will also benefit from this plan. 50 years ago, Starbucks was founded as a different kind of company, a company that would balance profit with social conscience and embrace the ideal that doing good for one another and for society would actually be very good for business over the long term. Our performance in 2021 demonstrates the wisdom and correctness of that founding principle. As we enter our second 50 years, we continue to honor our history and heritage, just as we boldly reimagine our future. And with that, I'll now turn the call over to Rachel. Rachel?
Thank you, Kevin, and good afternoon, everyone. It's my privilege to share with you Starbucks' strong finish to fiscal 2021, our 50th year in business, delivering the highest full-year revenue, operating income, and EPS in company history, an accomplishment that is truly special considering the profound challenges we have navigated throughout the pandemic. Please note that as Greg discussed at the top of the call, fiscal 21 results that I will discuss today are non-GAAP unless noted, and on a 14-week basis for the quarter and a 53-week basis for the year, except year-on-year revenue, comp, operating margin, and EPS growth metrics, which will be on a 13-week or 52-week basis to exclude the impact of an extra fiscal week for comparative purposes. In Q4, Starbucks global revenue reached $8.1 billion, up 22% from the prior year, setting another quarterly record along with a fiscal year record of $29.1 billion, primarily driven by the continued momentum in the U.S. and strong contributions from across the globe despite the severe headwinds of the COVID Delta variant. Our consolidated operating margin was 19.6% in Q4, up 580 basis points from the prior year. The increase was primarily driven by sales leverage across the P&L as we lapped the COVID-19 impacts and related costs, as well as pricing in North America. These were partially offset by rapid inflation related to logistics, commodities, and labor costs across our supply chain. Q4 GAAP EPS was $1.49, inclusive of a 56-cent divestiture gain from the Starbucks Coffee Korea transaction, which yielded pre-tax proceeds of almost $1.2 billion. Q4 non-GAAP EPS was $1, capping off the company's most profitable year ever with non-GAAP EPS of $3.24. I will now provide some segment highlights for Q4, and then we'll provide guidance for fiscal 2022. The North America segment delivered revenue of $5.8 billion in Q4, 27% higher than the prior year, primarily driven by a 22% increase in comparable store sales, including 18% comp transaction growth and a 3% increase in average ticket. In the U.S., comparable store sales reached 22% in Q4, driven by transaction comp of 19%, delivering another sequential improvement in two-year transaction comp in the face of COVID Delta variant disruptions. Simultaneously, we maintained our strength in average ticket, up 3% over the prior year in Q4, remaining near record levels and posting two-year ticket comp of over 20% for the sixth consecutive quarter. Cold beverages reached 75% of total sales in Q4, contributing to our ticket strength, along with outstanding results from our fall promotion and another record quarter of food attach. North America's operating margin was 22.5%.
No, I'm not an economist. I am currently in a bachelor's program for finance and accounting, and I've read a lot of economics, but I do not have any formal degree yet or any real proper certification. Just a lot of effort and experience, I suppose.
Area transformation also offset the margin headwind of approximately 270 basis points over the past 2 years from sizable investments in wage and benefits, as well as supply chain inflationary pressures. Moving on to international. The international segment delivered record revenue of $1.9 billion in Q4, growing 18% over the prior year. The growth was driven by an 8% increase in net new stores over the past 12 months, strong sales growth from our international licensees, as well as a 3% increase in comparable store sales. Both company-operated and licensed markets across our international portfolio are contributing meaningfully, with double-digit sales growth in key markets like Japan, the UK, Korea, and Mexico. Kevin noted that the COVID-related volatility drove comp sales down 7% in China in Q4. However, our experienced team and 22-year history continue to serve us well, as operating income was only down 1% versus last year. Our team in China and across the globe has done a tremendous job of managing through the volatility. In fact, operating margin for the international segment was 22.8% in Q4, expanding 650 basis points from the prior year, well above pre-pandemic levels, mainly driven by sales leverage as the segment continued to recover from the pandemic. Higher government subsidies, lapping store asset impairments in the prior year, as well as store and overhead labor efficiencies also contributed to the expansion. We expect margin to settle a bit in fiscal 22 versus the levels of the past 2 quarters, as government subsidies are not expected to repeat, and we have pressures relating to the impacts of inflation. The opportunity ahead, coupled with tremendous experience and a strong diversified portfolio, has us very optimistic for the future growth of China and our other international markets. On to channel development. Revenue was $438 million in Q4, a decline of 10% from the prior year, primarily driven by Global Coffee Alliance transition-related activities, including a structural change in our single-serve business. When excluding the approximately 20% adverse impact of these transition-related activities, channel development's revenue increased by 10% in Q4, primarily driven by growth in the Global Coffee Alliance, as well as other international ready-to-drink business. As a reminder, Q4 was the last quarter we will be lapping this transition, so we expect channel development to return to more normalized reported revenue growth levels in fiscal 2022. The segment's operating margin was 50.2% in Q4, up 960 basis points from the prior year. Normalizing for the 890 basis point impact of Global Coffee Alliance transition-related activities I just mentioned, Channel Development's operating margin expanded 70 basis points in Q4, driven primarily by lower trade spend in our international ready-to-drink business. Now we'll turn to our fiscal 22 outlook. For fiscal 2022, we are expecting global comp sales growth to reach high single digits as we lap prior year impacts of COVID and continue to build on our Q4 momentum. This also reflects our thoughtful pricing actions, which are expected to further bolster our comp growth as we work to offset the impacts of inflation across our supply chain. New stores will also contribute meaningfully to our growth in fiscal 2022. We expect to add approximately 2,000 net new stores globally in fiscal 2022, up significantly from 1,173 in fiscal 2021, as we've successfully completed closures under our North America Trade Area Transformation Program and are now refocusing on expansion. We estimate that approximately 75% of our net new stores will come from outside the U.S. as we continue to diversify our global portfolio across highly profitable markets. This represents global net new store growth of 6%, returning to our ongoing growth model. With this powerful combination of global comp and store growth, coupled with the continued strength in our Channel Development segment, we are expecting consolidated revenue to range between $32.5 billion and $33 billion in fiscal 2022, running well above our long-term guidance of 8 to 10% growth, setting us up for another year of record performance. As Kevin mentioned, fiscal 2022 will be a pivotal year of investment, marked by increase in wage investments to further support our store partners in this critical moment, helping to ensure we have, 1, the very best talent to drive our business forward, and 2, the ability to continue capturing and maintaining meaningful category share gains. Accelerating our growth and share is fuel for future margin expansion, as sales leverage is one of the most meaningful expansion opportunities we have. So while we'll see an impact to operating margin in fiscal 2022 resulting from these investments, increasing our share of customers now will drive long-term earnings and value for all Starbucks stakeholders. The success of Starbucks starts with our partners, and we are committed to continuing to invest in them as a critical strategic differentiator for our business. With these investments, we expect fiscal 2022 operating margin to be approximately 17%, below our long-term target, driven by approximately 400 basis points of impact related to the wage investments, coupled with an additional headwind of approximately 200 basis points from a combination of inflationary pressures, other growth investments, and discontinuation of government subsidies. Further, our fiscal 2022 margin expectation reflects factors unrelated to our core performance, with an approximately 40 basis point dilutive impact from a combination of the Starbucks Korea transition as well as a change in non-GAAP reporting treatment, both representing a one-time step down in margin. However, we will meaningfully offset these margin impacts in fiscal year 2022 with benefits from pricing, leverage on our expected strong sales, and productivity gains. Importantly, given our continued proactive actions to continue to drive margin expansion and leverage accelerated sales growth, we expect our operating margin to return to the ongoing target of 18% to 19% in fiscal 2023. While fiscal 2022 margin represents a departure from our long-term growth algorithm, we believe the value these strategic investments will create for our partners, our business, and all of our stakeholders will endure for many years to come. We are pleased that, as we had previously committed, we successfully managed our leverage ratio back within our target at the end of fiscal 2021. As a result, we plan to reinstitute our share repurchase program beginning this quarter and are committed to returning $20 billion to shareholders, or approximately 15% of our current market capitalization over the next 3 years. With this commitment, Starbucks will have returned over $45 billion to shareholders since fiscal 2018, or approximately 35% of our current market capitalization, while simultaneously delivering on our algorithm for double-digit EPS growth at scale. Approximately 2/3 of this $20 billion will come in the form of share repurchases, with the proceeds from the Korea transaction pushing fiscal 2022 repurchases a bit higher than the following 2 years. The remaining 1/3 will come through a very competitive dividend, targeting an approximate 50% payout. To support this plan, we plan on issuing a moderate amount of incremental debt while retaining leverage below our target of 3 times rent-adjusted EBITDA, consistent with our existing BBB+ rating. As a result, we expect interest expense to be between $490 million and $500 million in fiscal 2022 versus $470 million in fiscal 2021. Capital expenditures in fiscal 2022 are expected to total approximately $2 billion, up from $1.5 billion in fiscal 2021 and back to pre-COVID levels, reflecting increases in new store development and technology initiatives in our stores. As always, we plan to focus on capital spending in fiscal 2022 on opportunities that drive significant returns across our global retail portfolio. We expect our non-GAAP effective tax rate to be between 24% and 25%. This range translates to an EPS headwind of roughly 4% year on year and is meaningfully higher than the non-GAAP tax rate of 21.3% in fiscal 2021, which benefited from certain discrete tax benefits that are not expected to repeat to the same degree in fiscal 2022. When you add it all up on a 52-week comparative basis, we expect fiscal 2022 GAAP EPS to decline by 4% or less. We expect our fiscal 2022 non-GAAP EPS growth to be at least 10% from the base of $3.10 in fiscal 2021 that excludes the extra week and is adjusted for the change in non-GAAP treatment of certain integration costs. With the phased rollouts of wage investments and the ongoing global recovery from COVID throughout the year, we expect fiscal 2022 quarterly non-GAAP EPS to be the lowest in Q2 before peaking in Q3 to form a strong back half of the year. We recognize that this earnings guidance is a temporary change from the outlook discussed at our Investor Day in December 2020, driven by wage investments as well as faster than expected recovery in fiscal 2021. We continue, however, to stand by our commitment to the growth algorithm over the longer term. The strategic investments in our partners are the right thing to do for our business and all of our stakeholders, and we are confident this provides the foundation necessary to continue to grow our coffee leadership position for many years to come. To summarize, here are the 3 key takeaways from my discussion today. First, we are thrilled with what we accomplished in fiscal 2021, far surpassing the pre-pandemic performance levels to deliver record high revenue, operating income, and EPS, even as global consumer mobility remains suppressed and inflationary headwinds pressure our business. Second, fiscal 2022 will be a year of outsized investments, prioritizing our store partners and ensuring we have the very best talent to drive, capture, and maintain lasting category share gains while still delivering double-digit EPS growth and initiating a return of $20 billion to our shareholders over the next 3 years. And finally, we remain fully committed to our ongoing growth model and expect to progress towards our algorithm with an operating margin of 18% to 19% in fiscal 2023, while continuing to balance returns and investments necessary to sustain this performance over the long term. Of course, all of this is made possible because of the significant efforts of our Starbucks partners around the world who proudly wear the green apron. It is their unwavering commitment to serving our customers that drives the financial results and outlook that I've shared today. With that, Kevin and I are happy to take your questions, joined by John Culver, Michael Conway, and Leo Soy. Thank you, operator.
Thank you. As a reminder, if you'd like to ask a question, press star, then the number 1 on your telephone keypad.
Go to my channel page on YouTube.
Questions as possible.
And like near the top hand right, there should be an icon to link that'll link you to my link tree, and then that has all the different links on it. Also, please like the stream if you're still watching.
This year, and then growing to 18 to 19% in 2023. And I'm just wondering if you could sort of paint the picture of how you get from this year's margin outlook to next year's margin outlook. Are there certain offsets that are going to develop throughout the year that will lead to better performance, or is there something one time in the cost structure this year? Anything you can do to help provide some visibility on that path would be great.
Yes, thank you for the question. What I'd say is when we look at our margin that we're guiding for this year and we think about where we're headed to next year, as you know, there are over 640 basis points of dilution to our margin this year, given the investments we're making as well as some of the inflationary headwinds and changes as outlined in my prepared remarks. We're going to work this year to offset the majority of that through pricing, through sales leverage, through productivity and other efficiency measures. As we move into FY23, we'll continue those efforts, and that's going to allow us to return back to the 18 to 19% margin that we guided for the long term. We feel confident in that, given that our growth at scale agenda and our focus on pipeline of innovation, our ability to continue to grow our digital customer memberships, and our ability to continue to accelerate the service experience through new stores and through the experience we're creating in stores, coupled with productivity and efficiency throughout our global network, is really what allows us to continue on that path towards 18 to 19 margin in line with our long-term guidance.
And David, this is Kevin. Let me just add to Rachel's comments. The strategic investment we are making in wage, here's how to think about it. First, our Q4 and FY21 revenue results demonstrate that we are growing faster than the coffee addressable market as estimated by Euromonitor. We are taking market share. Then if you look at consumer mobility, it's going to continue to increase. And we want to recruit and retain the very best talent for our stores. The most important investment we can make is in our Green Apron partners. We know this to be true because it has been proven time and time again throughout our 50-year history that when we take care of our partners, they always rise to the occasion and create that unique Starbucks experience for our customers. Clearly, from my perspective, this investment in our partners is not only the right thing to do for them, it's also the right thing to do for all stakeholders, including our shareholders. We're on the front foot right now, and we have this opportunity to accelerate by investing into the growth curve. This means with this investment, we predict higher market share gains as consumers return to our stores, and these share gains will be permanent. And these share gains will create long-term shareholder value. If you think about it and you model this, those permanent gains, we know we get operating leverage as we get more customers. So if you just take the share gains and you run the spreadsheets on operating leverage, that is what's going to create, this is actually going to increase the terminal value calculation for Starbucks. And we're so confident in this strategy, in this investment, that's why we're committing this $20 billion return to shareholders over the next 3 years. So this is all about leaning into the growth, taking market share that's going to be permanent, and the benefit of that market share is going to create significantly more shareholder value than we would have created without the investment. And we're so confident, we're $20 billion return to shareholders in dividends and buybacks. That's how I think about it, and that's how I think every shareholder ought to think about this investment.
Great, thank you.
Thank you. Your next question comes from Andrew Charles with Cowen. Please proceed with your question.
Great, thanks. I just have a two-part question. Kevin, what do you attribute to the U.S. acceleration in September?
Yeah, I just went and double-checked it myself. I found that. I have no idea why it's closed. So, sorry. I'm not really sure. I can't really get you the link right now beyond that.
Account that guidance is contingent on to help flesh that out. That'd be very helpful. Thanks.
Yeah, Andrew, I'll take the first part of your question, and I'll hand it to Rachel.
Yeah, I'll do that. I'll get it, and I'll put it in the comments after I'm done.
It creates this variability in consumer behavior. So, as you saw in the United States, more government restrictions, and many of these were done state by state and city by city that we had to respond to. That, I think, was the impact in August. And as we responded to those, and certainly as I think, consumers start to see the Delta variant curve starting to slow, consumer mobility unfolds. So these are all transitory and they're unpredictable. It is all related to the pandemic. So the acceleration that we saw in both the U.S. and China are the exact same reason. It's just the variable of dealing with a global pandemic, and when these Delta variants or these other things pop up, it does have some impact on consumer mobility. But the one thing we know for sure, absolutely, we see it in every market around the world, that as the spread of COVID gets under control in market by market, customers return to our stores immediately. That's why this investment in wage and ensuring we staff our stores with the very best and most talented Green Apron partners we can is so important. This is the right time to make that investment, and we're confident that investment is going to return significant value to shareholders. Rachel, you want to take the second part of your
Sure.
question?
And for the second part, Andrew, what I would say is generally we're looking at about approximately 1% impact to EPS from the share repurchases, which is in line with our long-term guidance. Slightly elevated this year, just given that this year's repurchases will be a little bit higher than 23 and 24, given the impact of the proceeds from Korea, but approximately 1%, and that's provided in our guidance.
Thank you. Our next question comes from the line of John Ivankoe with J.P. Morgan. Please proceed with your question.
Hi, thank you. Just looking at the numbers, it seems like one of your biggest opportunities is, bringing back the U.S. traffic counts, I guess to at least what they were in 2019, if not even above what they were in 2019. So I wanted to get, your sense of, the visibility of that happening. If there are any green shoots, for example, suburban drive-throughs, for example, that are seeing that increase in traffic, and do you think you have the staffing today in the stores, that would allow that, return to traffic, or would it be necessary to add a step function change in some of the labor hours, to reach that increased consumer demand? Thank you.
Thanks, John. We'll head to John Culver to share perspective on your question.
Yeah, John, we're seeing, obviously a record number of customers coming back into our stores, and that's signaled by the significant transaction growth we saw quarter over quarter at plus 18%. What we're seeing from a behavior standpoint are very similar behaviors from customers as we've had in prior quarters and pre-COVID. So routines are beginning to normalize. I think it speaks to a little bit around what Kevin said, that as people become more mobile, and particularly as we launched our fall campaign, normal routines entered with kids going back to school. Our peak hours have returned to pre-COVID behavior. They started in Q3 and it continued into Q4. Morning day part, very strong growth on a year-over-year basis, as well as midday, and then into the afternoon. We're seeing a very high beverage and food attach, and really a shift to cold beverages that we talked about on the last earnings call. Cold beverages actually accounted for 75% of our beverage sales in the quarter. But food equally was strong. We were up 35%, espresso was up 34%, and we are seeing larger tickets come through as well. So when you look at it from a store standpoint, we're very pleased with what the performance has been. First in rural and suburban areas where our drive-thrus are most common, and which helped carry us through the COVID period, and over the last 18 months, we're very strong, and they continue to show strong performance. Our urban stores have reached recovered status, and we're very encouraged by that. And then from a central business district, recovery has been slower, but it continues for the second quarter in a row. Central business district is returned to a positive comp performance as well. And then last thing I would just leave you with is what we're seeing on the convenience aspect of Starbucks, and in particular, the growth of drive-through and the growth of MOP. And we've done a lot of this during the trade area transformation work we did around the stores. Today, drive-through and MOP accounted for 70% of transactions, which is up 15% versus pre-pandemic levels. So, we're very encouraged with the momentum that we've been able to build. And then obviously with the investments that we're making in our people from a wage perspective, we expect to continue to increase staffing levels, continue to increase the training for our partners, and we are very, very well positioned for a very strong holiday season.
All right, we'll go ahead and cut the call there since I'm just about done with this 10th year, and then we can get into some analysis. But yeah, after the stream is over, I'll go and get the Discord link and post it in the comments, and then I'll figure out what the hell's up with that link tree. I haven't looked at that link in probably like 4 months, so who knows how many times people have tried to click on it and it be apparently broken. I don't know what it means by saying that I apparently was using it against the rules or whatever. I don't know what that means. I don't remember getting any emails on the subject, but whatever. Anyway, Starbucks. Let's go ahead and just get into that. Let's make sure the Google Finance function is actually working. So for the sales to capital ratio, as I had already said, outside of this 2018-2019 year, where clearly because of the shift in their acquisitions and capital structure, they had a little bit of a weird thing going on. You can kind of look over the long run that it actually has been pretty stable in a pretty strong way. It does average out at a pretty high level. Over the 9-year period, it comes to 4.89, but that's including those outlier years. So if you take the average, not including those outlier years, you get an average of 2.98. So thinking about 2.98 perhaps as our basin is a good way to think about it, or we'll actually just use the 2-year average, which is 2.12, perhaps as the basin, but then maybe we'll drift up closer to 3 for their forward projections. But we'll get to that part, the forward projection part, when we get there. Moving back up into the actual balance sheet and taking a look over the long-term history of it, continuing what I was saying, that like, for example, the shareholders equity is a recent addition after all of the activity that we talked about in those few years. So it's very possible that they'll be able to build back after that. Though it is worth noting that their shareholders equity was actually rather flat before that. In a real consistent way, so that doesn't necessarily give me a huge confidence that it can grow. It looks like that particular area was staying pretty in a flat, consistent area, as well as so is their retained earnings. So it wasn't going down, but it also wasn't growing. So that doesn't give me a huge lot of confidence that this negative number will continue to grow. But as I've said before, that isn't necessarily a deal breaker in and of itself. And then looking at overall liabilities, the trend of the liabilities growing rather dramatically is continued over the 10-year period. It's a 10x in liabilities. That's pretty crazy. But on their asset end of things, it's a 4x. So they definitely are becoming more levered as things move on. That's definitely worth noting. Looking at the current liabilities, that's almost a 4x, while with the current assets, that's a little bit more than a double. So they also are becoming more levered on a operating basis as well as an actual capital basis. Taking a look at their returns on invested capital over the long period, does have a pretty solid, consistent, strong double-digit return on capital over the period, minus the kind of few exceptional years that we've talked about, as well as a year where they actually did have a loss. Average over the period in total comes to 64%, but if you remove those outlier years, then you end up with 28.87%. We'll maybe perhaps use a 2-year average as a basis thought in this case as well, which doesn't really change things overall too much. And then looking at returns on equity over the same sort of period, unfortunately they do have a little bit of a shakier scenario in the return on equity because of the fact that their shareholders equity is negative for the last few years. So their return on equity looks really great back before they made this shift in their capital structure, but since then it doesn't look so hot. But again, that could change moving forward. Taking a look at their ability and habits of paying shareholders over the 10-year period, we have a total $37.2 billion paid back to shareholders, and the amount that shareholders theoretically could have had without it being a problem was 42.7. So they're not overpaying their shareholders. That's pretty good. And then if you look at their corrected net margin over the period, you can see that they do have pretty consistently strong double-digit margins with a few deviations here and there. So looking at a 3-year period, we have that 10.66. Over a 5-year period, it's 12.63. Over a 9 to 10-year period, it's 11.38. So as you can see, they've had a pretty consistent net margin throughout the period. In fact, we might go ahead and just leave it at this 9-year average for our basis here. Looking at their tax rate, 21 to 22% seems to be about where it lines up, considering this is just the measure that we use for calculating our discount rates. It doesn't have anything to do with the net margin itself. We actually attribute these separately, so we don't really need to think about whether or not this is too high or low for that reason. We really just need to think of it too high or low for the ability to get a tax benefit to interest reasons. So that's fine. And looking at their interest rate for nearly the same reason, we see that over the 3-year rolling average period, it comes to 2.18%. It's a little bit lower than the book listed effective rates that we saw for them, but in this particular case, that would actually end up being the more conservative end of things. If we take maybe a 5-year average to maybe push up slightly to 2.33, I think I'm probably comfortable with that position. And then if looking over their revenues over the 10-year period, sort of consistently what I was talking about, they have a very consistent double-digit revenue growth in pretty much every year, except for a couple exception years, and then 2020 was the 1 year where they're down. So looking at a 5-year rolling CAGR period, you can see that for the 5 years in the first period of the 10-year historical area, we get 10 to 11%, but then you can see that the revenue growth has been slowing down throughout that period, slowly through this period, and then as a result of the downward dip in 2020, it dropped dramatically, but then spiked back up in 2021. So I think it's pretty easy to assume that in 2022 and forward, it would probably be higher than this number, but perhaps lower than this number. So we'll maybe use something in that range of thought when we're making our projections. So with that, we'll actually come over here and start working on our actual projections. Don't get attached to this number up here because it doesn't have any of our assumptions in it yet. But as far as assumptions go, we'll go ahead and start at the bottom of the page. After adjusting for leverage, which apparently their debt to equity ratio comes out to 17 to 18% or so, we come up with a levered beta of 1.18. So it's not too bad considering they're not super levered, but that does bring their cost of equity up to 7.95%. And then as a result of their overall interest setup, that brings their weighted cost of capital relatively low. Actually, I think because of the tax rate scenario, that might be representing it too low. So maybe we'll shift the interest rate that we're going to use for that from the weighted 3-year rolling period to actually the listed number, which is 2.95. That brings the weighted cost capital up to 2.3. That makes a little bit more sense. That's more in line with what we would expect. Not a huge deviation, but it makes a little bit of a difference. So then getting into what our projections are actually going to be for this, we have a range from 0 to 100% for debt to equity ratio, which is definitely going to be way too wide. On an expected basis, that brings it to 46% with no adjustments. So if they're currently at around 20%, with a market cap of 120 billion, and we assume that maybe they have a pretty dramatic drop in market cap, maybe like even 30% or so, down to 80 billion, and then they have about $23 billion in debt. So perhaps they double their debt while also having a dramatic drop in market cap. That could easily bring their debt to equity ratio possibly to the range of 75% in a worst case scenario. So perhaps that could be our basis for that, and 0 would probably be a fine enough position to have for the best case scenario, considering how low it already is, but 25 would probably be too low for generally anything else. So without adjusting for probabilities, that brings our expected value to 34%, which is still a little too high. 50%, that was also on the assumption, or the 75% was on the assumption that their debt actually doubles while taking a 30% cut to market cap. But doubling may be a little bit too much. So if you make maybe a 50% jump in it while also having a third drop in market cap, that could bring it more in line with perhaps a range of 50 or 60% instead, which brings us to an expected value of 27. So maybe we'll go with 50. That brings our expected value to 23%. I think that's without adjusting for probabilities, which we'll probably do a little bit of. So I think that's probably a fair enough range as far as expectations for debt to equity ratio, anywhere from 0 to 50%, with a leaning towards possibly around 15%. That has having to do with their current position of around 19 to 20%. So then with that, we can move on to the sales to capital ratio, which is way too low compared to where it needs to be. Again, as we were talking about, we're going to use our basis of about 2.12, which actually, no, considering with the position and everything, I'm actually just going to use the 1 year average for that. So it's really just going to be the 2.46. And then I think we will have it sort of drift closer to 2.75 as a median's position, which maybe 1.5 as sort of the worst case scenario. And then it could be pretty significantly above that for the best case scenario. something in that range. We might adjust it a little bit further. So moving on to margins, we're definitely going to have to bring that up pretty significantly with our median case currently around 10%. And as we've said, the 9-year rolling period is around 11 to 12%. And their more recent year of good averages outside of the crisis year was kind of in this range of around 14%. So I do kind of want to use this as sort of our basis area. I can see if 14 is where they're currently about, I could see them in a best case scenario pushing a little bit higher than that, but really not too much higher than that. But then on a worst case scenario, you could easily see them coming back down more in line with where typical beverage retailing positions might come out to, which would be back down more into single digits. As far how far below we necessarily want to put it is a little bit up to one's own personal flair of conservatism. Maybe put this at around 13 or 14% for the analyst case. Could argue that even maybe 10% is a good minimum case. We might shift the probabilities on this one instead to things around. We'll adjust with that. Now let's take a look at revenues. Now, as far as a worst case scenario, negative 5% might be a fine enough worst case scenario, but I might also just put it down to 0 and shift the probabilities accordingly. As we had already said, I personally think that where we want the median case to end up is probably, or the average case, is to probably be somewhere between 6 and 10. I'm not entirely sure exactly where, but they have consistently gotten double-digit to upline growth for many years, so you definitely have to leave a very solid amount of probability for that to occur. It could even be pretty dramatically high. 20% for a compounded 5-year period would be probably a little too much, but we can adjust that accordingly with probabilities. Again, because I mean, just 10% was consistently being reached here. So I do want the overall expected value to be in the single digit range, but I do want to leave a significant chance for double digit growth as well. So maybe bringing the worst case down to or up to 0, and then the best case down to 15. That brings us an expected value of 7% with a mid of around 7.5. We could bring the analyst case up to 10%, which would bring the expected value to 7.88. This is maybe a fair enough range for revenues. You could argue it could be higher, but again, like I said, we're going to shift the probabilities around a little bit, I think. So we'll probably tilt it a little bit more towards the optimistic end. Let's see what tilting pretty heavily towards the optimistic end looks like. That brings the expected value to 8.81%. But then where does that leave everything else is the real question. That leaves our expected net margin around 13%, which would make me want to shift the worst case scenario option downward a little bit. And then that leaves currently our implied returns on invested capital on an expected basis comes out to 38.5%, which, you know, compared to the most recent year, that's a pretty reasonable range to have. Over the long run, obviously they've had a pretty crazy return on invested capital set up, having to do partially because of these outlier years that are involved here. So it's a little bit harder to measure, not to mention the negative shareholders equity has an effect on the perceived returns on invested capital as well. So 38% seems relatively high, but that actually sort of makes sense for what we would expect. But that also means that we can't necessarily expect to push it much higher than it currently is, because that's about where everything currently is already at. Let's see, where did that shifting the probabilities brings the debt to equity ratio down to 20%, which is kind of where we actually really wanted it to be, because that's exactly where it is currently. And that does bring the expected value for the sales to capital ratio to 2.69, which is higher than the most recent year, but brings it closer to where it was a little bit more in the past. So I think that still makes sense. I'm not sure how much more I'm willing to do for this one, could argue that the margin should be a little bit higher. That's perhaps the only other thing. Okay, let me go take a look at what the analyst projections for the record. In this current next year, they expect 12.3% revenue growth and then 8.8% in the year after that. Which, I mean, if you compound between those two, it probably comes out to like 9 point something or so compounded between the 2 years, which is, again, that's only for those 2 year period. But if you carry it forward on the assumption that the years after that would be a little bit lower, then their CAGR may be roughly in line with what mine is. With the margin expectation that I've given them, combined with the revenue expectation I've given them for the analyst projected number, it gets a net income growth of 7.7%, and that's against the EPS growth expectations the analysts have of 33.74%. I do think that number is probably a little outdated. It's probably hasn't been updated recently, so it's reaching back a little bit closer to 2020, which would explain why it's such a large difference, because it was based off of the drop in the 2020 numbers. So I don't think that's entirely super useful for us, but if we assume a few percentage points of share buybacks on top of the organic net income growth, and this perhaps pushes the overall EPS growth into double-digit range. Nowhere near, again, where the analysts seem to be projecting, but it's at least in double-digit range, so it pushes it at least to a place that's in line with their historic past. So yeah, I think that's perhaps all I'm willing to do for them in this particular one. I could see myself maybe pushing the sales to capital lower line up a little bit further as well, but that actually didn't even help it. Yeah, I don't think there's too much else that I'm willing to do to give this one more of a break. This is basically about where I think things ought to line up. Maybe on this, we can take a look at what the 9-year average is. That has a large effect on it. Doesn't really, in fact, doesn't helps them slightly, so I guess we'll give it to them. A small way to be a little bit more generous. But I'm not really willing to push the revenue expectations or the margin expectations too much higher than this. So that kind of caps where my valuation is willing to go in this case. So we'll go ahead and adjust this for default risks, and then we will move on to complete the valuation. Hopefully this will help them out a little bit. It does look like it's going to. Okay. So we'll do that. Okay, so that's the probability, and that'll do it. Just a reminder, if you're watching the stream and you are enjoying this content, please subscribe to the channel, please like the video, please do all of those things. I will, like I said, get that Discord link as soon as the stream is over and put it in the description or the comments or somewhere. So this is pretty much what we get for StarBUX. Wait, hold on. One thing I need to double check. Hold on just a second. Oh, okay. All right. Anyway, so this is what we get for StarBUX, ticker SBUX. I assume it basically needs no real introduction. Most people know what they do. U.S. Treasury today is selling for 1.793%. The mature market equity risk premium that I get is 4.88%, and after adjusting for company specific idiosyncratic risks, I get a discount rate for StarBUX of 8.04%. After adjusting for, my bad. They also have a dividend of 1.96%. 5 years ago, they had sales of $21.3 billion, and that's compared to the current year of sales of $29 billion, which gives them 6.4 or so sales growth per year for the last 5 years. Their sales to capital ratio in the most recent year was 2.46. And that we compare to an industrial expectation for a sales to capital ratio of 1.32. So they seem to have relatively high sales compared to their capital base. They have returns on invested capital adjusted for the fact that they have a negative shareholders equity with our own arbitrary measure to come down to about 19%, which they have a debt to equity ratio of about 19-20% as well. On that debt to equity ratio, we have a default risk of less than 1%, so pretty negligible. And we have R&D adjusted profit margins of around 11% for them over a 9-year long run period, which compares to industrial expectations of about 13%. So a little bit lower on the margin area compared to what we would see on industrial expectations, but much higher sales to capital ratio. On net between the two measures, I would say that does give a good sign of a high quality business. Their profit in the most recent year was $4.2 billion or so, and they're currently selling for $100.12. The probability distribution that we're using for our valuation is pretty heavily tilted towards the more optimistic fourth model. So that's to keep in mind, but we do weigh in some negative outcomes regardless of that fact. In the worst case scenario, we project sales of around $29 billion in the 5-year forward period, with a best case scenario of $58.4 billion. On an expected basis, we have a value of $44.7 billion. That gets sales growth of anywhere from 0% per year for the next 5 years to possibly a best case scenario of 15% per year for the next 5 years. On an expected basis, we have about 8 to 9% or so per year. We have an expected sales to capital ratio of around 2.69% and expected returns on invested capital of around 39%, which seems extraordinarily large, but again, we kind of do a measure to adjust for shareholders' equity that makes their current shareholders' equity look much lower than it actually really is when you're not adjusting for the fact that there's a shareholders' equity. So this is actually much more in line with what they're currently doing. Their debt to equity ratio that we have expectations for them in the 5-year forward period is also still around 20%, so no real change there, and that will not change their default risk really either. They'll still have pretty negligible default risk, less than 1% chance per year. We have margin expectations of anywhere from 10 to 16% in the 5-year forward period on an expected basis, around 13.5 or so percent. Which gets us profit expectations in the 5-year forward period of anywhere from $2.9 billion in a worst case scenario to possibly $9.3 billion on an expected basis, around $6 billion. This compares to compared to the discount rate that we are using for the company, gets us a present value expectation of around $69.90. Nice. Which is 30% overvalued compared to the current share price. We also have 5-year forward value targets, unadjusted for the dividends that they would pay out during the period, of anywhere from $62.51 to a possible high end of $164.42. On an expected basis, $102.88, which compared to the price that they're currently selling at, gets an implied return of 0.55% per year for the next 5 years. So basically no returns really to be had on an expected basis according to this valuation. There is some best case scenarios where they do outperform, but on a model that calculates in some worst case scenarios as well as some best case scenarios and tilts it towards certain probabilities, we basically see no real returns on a value basis forward for Starbucks. We do come up with a value score for them of 0.68, which considering how low the returns are is actually a pretty high score to get, which does have to do with the pretty good qualitative factors that they have in the profit margin, sales to capital ratio, and returns on invested capital. There's a little bit of a problem going on with my pricing formula that I have here for the short-term regression multiple output. So this is actually wrong right here. The correct answer is over on this other page right here, where it actually correctly realizes that this one has to be taken out of the average, but it does mean that according to pricing metrics on the short-term basis, we could actually expect perhaps 4 to 5% of upside from the current price. So that could explain why the price is traded up this high in the first place, is that certain multiple-based market measures, which are more short-term in their orientation, have made people push the price up to the current level. But either way, we'll definitely keep an eye on Starbucks to see if it continues to decline moving forward. It's definitely declined pretty solidly for the last several months, and that was one of the reasons that it looked like it could perhaps be a decent deal, even though it was trading at a pretty high multiple, because I knew that there was some decent growth potential still in Starbucks and that it was a high quality business. Not sure what we're going to be taking a look at on Monday. I haven't really looked too much to see what other opportunities I want to look at possibly on Monday. I did get these recommendations from our commenter here in the chat today. Maybe I'll take a look at one of those, but it depends on whether or not I think it's fits the right criteria for interest. Unfortunately, I'm not gonna do it today while I'm on stream. Sorry. I'll maybe take a look at it afterward, and then, like I said, you can maybe try to hit me up on the Discord afterwards. But this is all we were going to do for today. But as I said, please like the video, subscribe to the channel, all that. We stream 2 times a week on Mondays and Fridays around the time that the market closes, and this is we do it pretty consistently. Different companies every single week. We never really have any idea of if something's going to be a good value or not until we get to the end. We take as close to an agnostic view as possible, and try to really decide what we think a company is worth. And well, if it's worth it, then maybe we invest in it, and if not, then we just move on to other companies. So anyway, that'll do it for us today, and I'll catch you all next time.